Welcome to the Slop Farm. Enjoy the video.
In this video, I will explain how to calculate options profit on Robinhood. Follow along with examples for calls, puts, break-even, and net profit calculations. Start by noting strike price, premium paid, and contracts owned, then convert contracts to shares using the 100 multiplier. Subtract total premium from intrinsic value at expiration to find profit, and we will run clear examples for a call and a put to make this practical. Use a call with strike 50, premium 2, and stock at 60 to show intrinsic value and profit. Use a put with strike 40, premium 1, 50, and stock at 30 to show how puts gain value. Multiply by 100 per contract and subtract total premium to get your net profit or loss. Calculate break-even precisely. For calls, add premium to strike. For puts, subtract premium from strike, then evaluate probability of expiring in the money. Consider delta for directional exposure and theta for time decay impact on option value. Run scenarios for stock moves of 10% up or down to see potential profits and losses. Keep position size and risk limits aligned with your account and trade plan.
Thanks for watching. Consider subscribing if we helped you today.